Hello traders, this is James Stanley with StoneX and Forex.com. It was a historically bad first half of the year for the US dollar. The dollar was down by 10.78%. That's the worst half-year performance in USD since 1991. Despite that, Q3 was a slight gain for the dollar, but there are still many traders that appear to be pushing or trying to push the short side of the currency, and I think that sets up for a pretty interesting backdrop of reversal potential as we go into Q4. I want to look at this from a few different perspectives: a technical perspective, fundamentals, sentiment, and then one of components, because after all, we're talking about currencies. Currencies are the foundation of the global financial system. Only way to value a currency is with another currency, and that brings on some unique factors, shall we say. But let's get to the chart, start dicing this up, and look at this from a few different perspectives. So first and foremost, add some color to what I said a little earlier, where it was the worst half-year performance in the dollar since 1991. You can see here, in the first 6 months of 2025, the dollar was down by 10.78%. To get a larger half-year sell-off in USD, we have to go all the way back to 1991, the second half of 1991, when it was down by 13.05%. Now, a lot's changed since then. Like, for instance, we had this run from the 2001 high to the 2008 low. That is when the euro came online. And so we had global central banks that were shifting some of their reserves from USD and into euro just to allocate across a different currency. And it was a supranational currency, so to diversify their holdings, so to speak. We've since retraced about 50% of that move, but that was a clear and decisive trend that had taken place in the dollar. Before that, we have to go back to 1985, and that was the Plaza Accord. The Plaza Accord was resultant of the Fed's rate hikes. It was a solve for the USD strength that came about from the Fed's rate hikes in the early 80s, designed to stem inflation. When we had this pronounced run of USD strength, it made it really difficult for American corporates to operate outside of the US. I mean, even in the US, where it made it more advantageous for, like, say, a Japanese auto manufacturer to sell cars in the US than a US auto manufacturer. The Plaza Accord essentially was a monetary reset, and you can see where that led to a significant downdraft of dollar weakness, the net of which eventually led into one of the most prosperous periods in American capital markets, well, at least at that point, that we had ever seen. I think this also is something that President Trump is pushing towards. He had a comment in July, and I think that the backdrop from the Plaza Accord is somewhat informative as to this stance. And the quote is, "So when we have a strong dollar, one thing happens. It sounds good. But you don't do any tourism. You can't sell tractors. You can't sell trucks. You can't sell anything." He then went on to say, "It's good for inflation. That's about it." So I think the drive that we've heard from President Trump in the first half of the year to try to get the Federal Reserve to cut rates was designed to help weaken the dollar and in turn put the wind behind the sails, so to speak, for American corporates. I think that's why there's been such a drive to cut rates, even with inflation remaining high. But it's the very real question as to whether or not we would get the same response in markets that we had back in the 80s and the 90s, because it's a very different period. Namely, we had this period here when the euro came online. And then perhaps more to that point, we could see from the episode that happened in 2022 when the Federal Reserve had to hike rates aggressively to stem inflation, the highest inflation we had seen since the early 80s. Well, in essence, those rate hikes just exported inflation to Europe, at which point the ECB then had to come to the table with rate hikes. And then the US dollar pulls back, the euro gains. It's a different economy than it was 30 years ago. And I think this really brings on the question as to whether or not a prolonged bout of dollar strength would be a positive for not just the global economy, but for the American economy. Nonetheless, if we look at what happened last year in the US dollar on the back of the Fed's rate cuts, the Fed cut rates right here on Wednesday, September 18th. At that point, markets were already well expecting those rate cuts. It was a 50 bip jumbo cut, despite the fact that the Fed went for the bigger rate cut. The dollar set a fresh low and then just stalled. And then continued to stall. And then it actually rallied in Q4 with aggression. By the time we got to the middle of the quarter, it was like that sell-off had never happened. Well, there was something else that was going on here. And this is what speaks to the problem from a fundamental perspective, which is markets, especially bond markets, aren't stupid. If the Federal Reserve is cutting rates when inflation is already high, then that increases long-term inflation expectations. It makes the idea or the prospect of holding, say, 10-year notes that are at a 4% yield a less and less attractive prospect. As a case in point, again, that first rate cut last year was on Wednesday, September 18th. Here in the 10-year, it touched a low just below 3.6% the day before. When the Fed cut rates, 10-year yields jumped and continued to jump through Q4 and into the 2025 open. Notice right here, 10-year yields topped at 4.8% on January 13th, the same day that the US dollar had topped. So even though the Fed was cutting rates in Q4 last year, it didn't matter here. Treasury rates are decided by the market, and this market is not stupid. If inflation expectations are going up because the Fed's cutting short-term rates with inflation already high, then investors aren't going to want to hold long bonds, and that's going to lead to higher yields, and higher yields can eventually impact stocks, but that's a whole other bag of worms. We're talking about the dollar here. But relevant to the discussion is the fact that USD last year, again, notice that low on Tuesday, September 17th, that high on January 13th. The US dollar tracked that. There's the low on the 18th, the day later, and then there's the high on the same day, January 13th. The dollar tracked 10-year yields more so than it did Fed policy. More recently, we had the Fed with a rate cut right here. After which we had a build of higher highs and higher lows. Notice similarly, the initial reaction in 10 years has been higher yields. We just barely ticked inside of 4% on the day of the rate cut announcement. We touched up to 4.2% just last week. So if there's a repeat scenario of what happened last year, this is something that I think could very much bring upon another run of USD strength. But there's more to it than that. It's not just from a fundamental perspective. If we look at this from a technical perspective, I think there's also a backdrop that could be befitting of USD strength. Last year, when we had that episode building, we had the build of a falling wedge formation. Falling wedges are very interesting formations because it's deductive. If you have a good, healthy, bearish trend, sellers should be willing to stretch down to fresh lows. They maybe some initial stall or trepidation, but eventually they should break through those lows to set lower lows and lower highs. It's when that starts to not happen that things get interesting. And the way I always teach this formation is it's kind of like that friend you have that talks a real big game when it's just you and them, but then you get them in public, you get them in a wider setting when it's a little bit more difficult to be bold or courageous, and they all of a sudden clam up. That's not the friend you want to take into battle with you. Because it's easy to be bearish at resistance or after pullbacks. It's more difficult to be bearish at lows or tests of support. And what you see in here is a bearish trend that's just long in the tooth. Now, there's two ways out of a situation like this. Maybe we get some really bad news that finally gives bears the motivation they need to break down to a fresh low, and then we get to fresh low. So that's possible. That can happen. Otherwise, that waning weakness as we get towards these lows could quickly reverse, just as it did right here. And that led to a snapback reversal. And then if you think about this from a positioning standpoint, what drove these lower lows and lower highs? More sellers than buyers, right? Those sellers are probably putting stops around these swing highs so that when we get a breach of these lower highs, notice what happens. Breakout. That's you can imagine stops getting cleared, adding an influx of demand into the market. We get a break of resistance. It's no stall. It's no no hold of resistance. It's breakout. It stops getting triggered, getting run, leading to more demand in the market, leading to a spike, until eventually that short squeeze becomes a bullish trend. That's the ideal play out for a falling wedge formation. Well, we have another falling wedge formation that's building right now in the US dollar. And again, if we look at this from a fundamental perspective, if we look at this from a rate expectation perspective, it has been the kitchen sink thrown at this thing so far this year. But the reality is the bulk of that bearish trend priced in down to about Easter, where we set this low on April 21st, and we're trading right around that same low right now. Even though we've heard Federal Reserve officials resigning, or maybe even being fired, or Jerome Powell getting replaced, we've heard all of these different items on that front with all of these rate cut expectations priced in, yet the dollar is just about where it was 5 months ago. We look at this from a weekly chart, that shows a falling wedge very clearly. You have that stalling at support or around lows, while sellers have remained aggressive near resistance or highs. And that sets the backdrop for a bullish reversal. Now, like I said earlier, a formation doesn't have to take place. It's just a possibility. It's a market observation that could lead to something because of a logical outlay of what's happened. It's possible that we get some other shoe to drop that finally gives bears the motivation they need to take out some of these lows, to maybe bring on a trend like we had back in 2001 to 2008 or 1985, maybe something like that. But from where we're at right now, the risk is to the upside. The level that I'm watching here on DXY is the 99 handle. There's two different things going on there. There's a Fibonacci retracement that's key. I'll show you where I get that from. That's the 2021 to 2022 major move. 102 is the 50% mark of that major move. The 618 of that is at the 99 handle. That 99 handle has been well trafficked lately. That set the low here earlier in April. Notice it was support. Then it came back in as resistance. We had these lower highs that developed. There was an open door for sellers to take the run. They set a fresh low and then they snapped it back. But that 99 level is now confluent with the resistance side of that formation. That's a major spot in DXY. If bulls could take this out, and I think they would need some motivation, like maybe a positive jobs report. And given where we're at with the government shutdown, that looks like it'd have to come from like ADP. But maybe a positive inflation print, something along those lines. If we take that 99 level out, the door's open for a wider USD reversal. Now, like I said a little earlier, we're talking about currencies here. Currencies are the foundation of the global economic system. So the only way to value a currency is with another currency. Euro-dollar is the value of €1 in terms of USD. For USD or DXY specifically, it's a little trickier because we're looking at the dollar basket, which is right here. This was an article I'd written, I believe it was last year, but I took this image directly from the Intercontinental Exchange's website on the product guide. This is the constituency of the DXY basket. It's 57.6% euro, 13.6% Japanese yen, 11.9% British pound, 9.1% Canadian dollar, 4.2% Swedish krona, and 3.6% Swiss franc. Why does this matter? Well, this is what makes up the dollar. If the dollar is going to go up, then we need to see these currencies weakening. If these currencies are strengthening, well, then it's going to make it difficult for that DXY quote to go up because the denominator in the quote is increasing in value. Thereby, the net would probably be coming down. Where this comes home to roost is this 57.6% allocation of euro. The euro is a heavy piece of DXY. Now, the explanation behind it is the DXY basket was made pre-euro, so it was like Deutschmarks and francs. So that when the euro did come into inception, they just conglomerated all of those European currencies into the euro, and case in point, it's 57.6% euro. A heavy allocation, and probably improper for where the global economy is today, hence there's no Chinese allocation in there. The sole allocation towards Asia is the 13.6% in Japan, which doesn't fit with today's global trade flows, but I digress. If DXY is going to stage a reversal, it's probably going to need some help from Eurodollar. It's probably going to need to see a breakdown in Eurodollar. And there could be, I think, a rational case for that. If we look at the way the euro traded last year, as the Fed was going into rate cuts, the euro was really strong in Q3 as those were getting priced in. On the day of the actual rate cut, so again, it was Wednesday, September 18th, notice that euro dollar goes up towards that 112 level. Again, it's Wednesday, September 18th, right there. It goes up towards that 112 level where it then stalls. But as USD strength comes back to life in Q4, euro dollar sold off aggressively and continued to sell off. Now, that sell-off lasted all the way until, boom, Monday, January 13th, the day that 10-year yields topped, the day that the dollar topped. And it happened right at a key Fibonacci retracement. That Fibonacci retracement is one that I've talked about many times before. I believe even in the Fibonacci video that I did for the StoneX TV feed, talked about this Fibonacci retracement. It's simply the 2021 high to the 2022 low. The low this year came in right at the 23.6 retracement at 102. The 618 is what caught the high in 2023. The 50 and 38.2 retracements define the range for a decent portion of last year, but it's more recent that matters here. From that 102 low earlier this year, we rallied up to resistance at the 50, and more recently it's been resistance at the 764 and 786 retracements of this major move. Now, remember when I said a moment ago about the falling wedge, where it's like that friend that talks a big game when it's easy and then they clam up when it's hard? Well, you can get kind of the same thing here, where when we get these pullbacks, bulls have been really active, as illustrated by these underside wicks. But when they have an open door to actually go for the break, to actually show how bullish they are, they failed. Again, last week or 2 weeks ago, with the Fed's rate cut. Fed cuts rates, say they're going to cut some more, or highlight they think they're going to cut some more, yet the pair pulls back. Now, again, we're still within that expanse. It's still too early to say this thing's going to break down. But this is what, again, further, I'm leaning towards that USD strength scenario, because this makes for a more attractive backdrop for swing trades and longer-term trends. Right now, euro is at a really big spot between that 764, 786, but this is going to be key as to whether or not the US dollar could break out from that falling wedge formation, turn in a reversal, and show a repeat of what it did last Q4. But that's what I'm looking at. I think that's the most attractive theme in the currency market as we go into Q4 this year. Looking essentially for a repeat of what happened last year. USD strength, higher Treasury yields, even though the Fed's cutting, even though the Fed's warning that more cuts are on the way, markets are going to look around the next corner to try to anticipate what's going to happen next. And that's what I have for this video. Thank you for your time. And as always, happy trading, ladies and gentlemen.